So, good afternoon, guys. So, today's on 17th April, Tuesday, 2018. So, I just want to break down the euro dollar, the most liquid pair on the currency market, and break it down for you and show you what my long-term bias is, what my short-term bias is, and what I think will happen in the market in the long run and in the short term, and the trades which you can execute and maybe make some money in the market. So I'll do my analysis in a top down perspective, meaning I'll break down the pair for you from all the way from the monthly, weekly, down to the daily, 4 hour and hourly setups, and show you some setups that you can maybe execute within the range that currently the market is trading, and how you can benefit from trading those ranges. So in this video, I'll only break down the euro. I won't break down any other pair, but I'll break it down in a good way, in a thorough manner, such that you'll be able to understand how we as Ken and Carl generate ideas, and how we get to trade in the currency markets, and how we make money. So I'll start with the first thing that we do in the markets. The first thing, currencies really respect key levels, and the first thing you do when you're trading currencies, most traders, I'm sure, most technical traders will first start by marking off the key levels. So I'll mark off my levels, and the first level that you have is this one. So this is the 1.15 region. I'll round it up to the 1.15 region. Yeah, so it's a good level. As you can see, the markets were ranging for quite some time now, approximately 2.5 years before they finally broke out last year. We had a retest of that zone, and now we are currently at this zone. So this zone is 1.25. Yeah, so if I mark 1.25, let me round it up to 1.25. So as you can see, the markets, when you use the look left structure leads clue, you can see the zone that was around that region, the 1.25. We had some price action stalling around that region. So that is my 1.25 region. I'll show you clearly. As you can see, the market stalled here. We had a soft break before we went higher, but the 1.25 is a good resistance zone to use, and you can see the markets have clearly rejected that zone. So those are my first two levels. Then we maybe have this level, which is the 1.205 level. So I'll use a horizontal ray for that region, 1.205. So I'll round it up to 1.205. It's always good when you know your levels, and when you know where the markets will come after they break out at a certain point, and what will happen. So as you can see, in the markets, we had this bullish run early 2017. We had this correction, which if we use our Fibonacci tool, we can see that the market completed an ABCD, a clean ABCD, pull back to 38.2. Though it was not really accurate, the market came shy of 38.2 with quite some pips. Then we went all the way to 1.25, which was in confluence, perfect confluence with the 27.2 Fibonacci target. So if you use Fibonacci for projecting your targets, I think as a trader, as a technical trader in the currency markets, Fibonacci as a way of projecting targets is a good strategy, especially when they align with key levels. So we had this trend line. I want to mark this trend line, and yeah, we have this trend line, and as you can see, currently the markets look like they'll break the trend line and go lower after some consolidation of maybe 8 to 12 weeks. So for the 8 to 12 weeks, we have indecision in the markets. As you can see, there is no precise candle that gives us a clear sense of direction. But from our analysis, you can see the moving averages might be preparing to cross over to the downside, and last week's close, which was, I'll make this more the way you can see it properly. So I'll try and zoom in. So as you can see, last week's candle was a shooting star, and we closed above the 8 moving average, exponential moving average, with some small amount of pips, perhaps 10 or 15 to 20. Then this week, currently, we can't base our decisions on this week's trading unless we look at Monday's close. So these were my levels, as you can see, and I'll perhaps mark I'll use a Fibonacci and highlight this. So as you can see, the markets have not touched 38.2, the 50% retracement level within the trend. So you could maybe see a break of this trend line and a break of a level here 1.22, and you could rally all the way to 1.205, which is in perfect confluence with the 50% retracement. Then we could maybe come back up and break 1.25 and head to 1.28, which is my next level. So 1.28, this is my next level for this pair. On a in a long-term perspective, this is my next level. So when I view the markets in long term, I see this level. We'll get to this level. I can't say when, but we'll get to this level and maybe soon. So perhaps you could see a rally, a crossover of these moving averages, a break of this trend line, and the prices could come all the way to 1.205 before going higher and taking out this level. That would be a retracement to the 50% level of this move that had no substantial retracement or eminent retracement. So I'll go down to the daily chart and break it down further for you. So I'll maybe get everything off and just leave the chart playing. So yeah, I'll put in daily. So this is my daily chart, daily. Internet is quite slow over here, so that's why it's taking some time to load, but it's okay. So yes, this is my daily chart. So as usual, mark your levels. So we'll start with 1.15, 1.205, and this is the 1.205 level, and this is the 1.25 level. So we mark them off. Maybe I can put in some rectangles so that we mark it as a zone. Actually, when we mark these levels, we don't mean that the markets will definitely respect 1.25. It's a zone, I think, of 50 to 60 pips. So perhaps anything from 1.2470 to 1.2530 is a price among the resistance price. So yeah, this is the 1.25 and the 1.205. Then we can have this level, the 1.22 level, which I was telling you the markets are currently trapped. I'll maybe put it black for you to be able to distinguish between the two and to differentiate which one is which. So as you can see, we had this break of 1.15, rally to 1.205, slight pullback. Then we went higher all the way to 1.25. We then came back lower, formed a neck, formed a double tops, but we expected a break of the neck and a rally. What happened? We had a false breakout, and immediately prices came back up to 1.242. We had this run, which was a higher low. We came out from the new high, but currently the markets are stalling. Simply they are ranging between these levels. So what do you expect of euro on the short term and in the long run? So we have this trend line, which had given me some ideas on some bullish trades, but I can see with what's happening currently in the markets. So we have this trend line, first touch, second touch, third touch. Maybe I can mark them for you to be able to see them. So we have this trend line, first touch, then we have a second touch on this level, and a third touch on this level. Okay. So we can maybe get this one out. So we have the first touch, second touch, and the third touch. So the third touch is in confluence with the 50% retracement, as you can see. This is a good retracement to the 50% level. The markets clearly bounced off the 50% with accuracy, and we went back up, but we never broke this counter trend line, which is very important. It is very important. We are currently actually in a kind of a triangle. Okay, I'll use a better color. This cannot be seen properly. It can't be seen. It can't be seen properly. So remember on the weekly we have seen that moving averages are preparing perhaps to cross over to the downside. That doesn't mean they'll cross over to the downside. That doesn't mean that short trades are what should be executed, but perhaps you could get ready for some short-term momentum of bearish momentum for some short-term bearish momentum in the market. So we have this yesterday's candle. Friday's close was a pin bar that's pinned on the 8 moving average, 8 exponential moving average, with a slight pullback on the 4-hour chart, which I'll show you when I go down there. Then Monday we opened and we went higher, but today we opened higher, but currently we're trading lower. So where do I see this market coming? From my weekly breakdown, perhaps you could see the markets come all the way to 1.205, which is also in confluence with the 78.6 pullback of this move. So what would happen is we'll see a break of this level, of this trend line, and a break of 1.22, and that break of 1.22 is what will ultimately make me perhaps execute a short trade with 1.205 in my mind. Currently I have a short trade in place, but the short trade, my target is not in 1.2, my target is not 1.205 zone. Actually I'm targeting 1.23. There's a zone, 1.23 is a zone around here, around the 38.2 pullback, and the markets have also been stalling around that zone, and I'll show you when I go down to the 4-hour chart. So my daily sentiment, on my daily chart, I don't want a break of the trend line and a break of 1.22 for me to expect the markets to go lower, perhaps to 1.205. So euro, I'm still bullish unless 1.22 is taken out. But for the short term, that's intraday trades and swing trades for maybe hours and perhaps a day or two, I'm short on the pair. And so let me go down to the 4-hour chart and show you why I'm short, and why you can also benefit from the short term trades, where you can get around 60, 70, 80 pips, which are not bad, for especially when the markets are ranging and the volatility is almost dead in the market. So I'll maybe go down to the 4-hour charts. So this is my 4-hour chart. As usual, I'll mark the levels. So I'll start with 1.22. When you're marking the levels, it doesn't mean you mark all the levels. You mark the necessary levels as you go down lower and lower to the time frame. Definitely a monthly key level will not be of any value to on the hourly time frame, and perhaps a weekly time frame will also will not help you while you're trading from the hourly time frames. So as you can see, like the 1.25 region is already far much, it's higher than we expect on the 4-hour chart. So we have 1.22, then we have 1.23, which is around this zone, which is 1.23. So as I don't know if you have noticed, but most of my levels are round levels. I like levels revolving around 50 and 00 at the end. I don't like levels which are just hanging like 1.241, 267. These are not really good levels. So I like rounding off my levels. So like this one, I'll round it off to 1.24, 250 maybe. Okay, so those are my levels. I'll let me highlight them for someone who can't see properly. So I'll highlight, that is my 1.23 level, which is my first downside target. Then we have then we have 1.22. So I'll put another, clone it and place it there. So we had this bullish run, then we had this bearish run to 1.22, and we came back up. If I use my Fibonacci tool and measure this retracement, it sums up to about 61.8, as you can see, something of the sort. Then we came back lower to this level, and currently we went back higher. Then today we are going back lower. So where do I see the market, and how have I positioned? How did I execute my short-term trade, and what led me to execute that short-term trade, and where is my target, and why do I think the market will go down? So from a top-down perspective, we have seen from the weekly chart that last week's close was a shooting star. and moving averages are almost crossing back downward. So from a top down perspective, we can also expect short term bearish momentum to the 1.205 using the weekly chart. When you go down to the daily, we saw yesterday's this was yesterday's move. It was a bullish run to this level, and today when we opened, we had this spike, especially after they opened, immediately after they open into European session, which opened at 10 a.m. Kenyan time. We had this bullish run and a spike, which I think was a stop loss, and for most guys who had placed their stop loss above the prior swing high, who had entered short and were expecting the markets to go directly. So I'm expecting the markets to go lower. So my first downside target is 1.23. So I expect perhaps you can remove this trend line. We had a false breakout of the trend line. So we could see a break of this counter trend line and a crossover, moving average crossover. Then you could see the markets visit 1.23, which is 35 pips. In the next 35 pips, you could see the markets visit this level. If 1.23 is taken out, you could maybe see the markets go down lower to 1.22. So currently I'm short on the euro. I'm short on euro dollar to 1.23 as my first target, my first downside target, and 1.22 is my ultimate downside target, and 1.205. So I have 3 targets for my short trade. Then I'll go down to the hourly. So on my hourly, I'll maybe leave my analysis because I'd earlier indicated to you that I was short. And so we had this trend line on the hourly, we had this bounce, then you had this bounce, then you had this move. We formed a double tops. After the double tops, we came back up with a spike. So most of the guys who had executed short trades based on the double tops were taken out by the big boys. Then we currently are sliding downwards. So currently I'm 60% in profit to my 1.23 level, which is 100 pips away. So I'm expecting before New York closes, my target will be hit, and maybe we could go down lower to 1.22 and 1.205 as I earlier indicated to you. So that's my euro breakdown for you guys, and once you get to the 1.23 and 1.22 level, perhaps I'll give you an update if I see any change in the market sentiment. So that's it. So that's it, guys. Have a good day, and may God bless you, and may the pips be with you.